last decade was probably the best to own and operate an insurance brokerage.
Today, my guest is Trevor Baldwin, CEO of the Baldwin Group. How you doing today, buddy?
Doing great, Al. It's good to be here with you.
Same here, man. I was very excited to do this. We go back a long ways, not too long because you're a much younger man than me, but your dad built one of the premier firms clearly in the Southeast. And the reason we got to know Davis Baldwin was we were working on a deal up when the banks were all hot, right, to do all these transactions. Back in the late 90s, early 2000s, we were working on a deal with a company called the Tribute Companies, which ended up being the first platform for First Union. And you guys were the first platform, or your dad was, for Wachovia.
That's exactly right. Yeah.
And when they merged, in theory merged, and I don't think people realize that really First Union bought Wachovia, but they kept the Wachovia name because First Union's name wasn't real good in certain areas of the country.
That's exactly right.
I think it was the Mid-Atlantic.
Kind of a reverse merger of sorts, I think.
Exactly. Yeah. So when that came together, right away, we were Tribute's advisor and put that together. And, the connection with Davis Baldwin was immediate. So, I sat in on a couple discussions and things like that. And, obviously your dad was a very dynamic insurance professional, built a hell of a company. And then all of a sudden, out of nowhere, years later, right, I get a call from you. I think 2016, right?
That's exactly right.
I know you're probably, if not the youngest CEO out there now, at 40, I think you just touched 40. You
just turned 40 last month, Al, starting to get old.
Yeah, yes, 40, 30. Just like you told me, where I am is, I'm 64. You told me I'm 54. So I'll buy into that.
60 is the new 40, Al.
All right, I'm good, man. I'm good. I'm still trying to keep my hair somewhat dark, but I haven't put anything in it yet for all the viewers out there. So that being said, you called me, and I knew who you were immediately. And I think at that time, obviously we're going back almost 10 years now. You're a 30-year-old guy, and here you are with, I think you were about 35 million in revenue at the time.
That's right.
And you came into New York. We went to the Four Seasons. We had lunch. I think Ray and Mike were there, if I'm not mistaken.
I think that's right. Yeah.
Okay. And we had a great meeting. We knew right away you were building something of high quality. Just, your strategy, your vision. You super impressed with you, young guy, positioning himself very well, and obviously had a big role in the company. I think your dad was still involved at that point, right? And I know he may still be involved now. I'm not sure, but I know you're carrying the ball here from the leadership perspective. But super impressed, and immediately we started doing some stuff and got some things done. And, kept in touch, did some deals. Like I said, I have a couple signature moments with you, over the years. The one was the one deal where you came up to New York and had me take it off the market because you really wanted it. We successfully did that. What a lot of people don't know is, we before you decided to take it public, we kicked around potentially bringing you a sponsor. You, like a lot of your competitors, the private equity sponsor, and we sat up in the office of a well-known private equity group, and and when you said to me, Al, this is a great group, but we're flushed with cash and we're going to do this, and you went public, I was like, hey man, go at it, and look where you are today, sitting at whatever you are, $1.4 billion. Back then you were, I don't even know if you were a couple $100 million at that point, maybe.
I think about 100 maybe 120, or not even now. I think we were 80 million in revenue at the time.
Yeah. It might have been, you're touching 100 million, but Trevor, from day one, was super impressed with you, not only as an insurance professional and a leader, but as a person. And to me, that's all that matters. And when you get older, as you are getting somewhat older, you're still very young, you'll see that the relationships and the friendships, and it's all about people. It's always about people anyway. And I think that, but it's been great, relationship. And I want the people to know, how successful you've been, and how proud I am to be involved with you and the Baldwin Group, over these last 10 years or so.
Thank you. Well, Al, we've, as you know, have enjoyed such a terrific relationship, and you have put a meaningful imprint on our business and our success over the years. And as you mentioned, have been really an important part of a number of really critical partnerships, our nomenclature for acquisition along the way that really helped kind of continue to catapult our success. So we've really, and I've really enjoyed the relationship we've built over the years, and I know it's only going to continue to get better and bigger.
No, no doubt, and we're still just scratching the surface. I mean, what you've done in a short period of time has been amazing. It's really been a really, really fun to watch. And, obviously being public is not an easy thing to do. And you and I talk about it all the time because, you're really, in theory, you're working for your shareholders and you're working for Wall Street because they're watching every move you make. And, you got to be super disciplined and smart. And I think, Trevor, the thing that I've always, acknowledged with you is that you were always very disciplined in your strategy and what you want to do, very selective in any kind of external growth with acquisition. We know the things that you would get excited about. Okay. We know the things that the Baldwin Group is known for. And it's a high level, very sophisticated group of firms that you've been able to put together on top of some very good organic growth that got you where you are today. So it's been a great run, and you're just starting, really.
That's the plan. We're just getting started.
So I think the people out there would love to hear about the Baldwin Group, what it looks like today, how it's broken out, your strategy, where you're building, where you think your growth targets are, things of that sort. Because obviously you're already public, so it's continually being judged in that realm, and how everybody looks at the world these days. And obviously the marketplace has changed quite a bit, which we'll get into a little bit. I want your input at some point
Yeah.
on some of the things that have been going on. But talk a little bit about the Baldwin Group and what you're doing and how it's broken down, what it looks like today, and what you expect it to look like in the future.
Yeah, absolutely. Would happy to do that, Al. So, as you know, and as you mentioned, I came from a family that's been in and around the insurance business for 4 generations now, and despite my best efforts coming out of college to try something new and spend a few years in private equity, I eventually was lured back in, and I joined a firm my father had started here in Tampa in late 2009. And as you shared earlier, my father, Lowry Baldwin, had built and run a very successful private insurance brokerage business in the 1990s. And then, after the repeal of Glass-Steagall and the time when banks became very interested in the whole thesis of kind of this, finance super center of sorts and coming into the insurance space, the Davis Baldwin became Wachovia Bank's platform acquisition to get into the insurance business in 2000. He pretty quickly figured out that working at a large bureaucratic banking institution was not going to be where he found long-term fulfillment. And so he had left and spent a few years on the sidelines. I was in middle school and high school at the time, so it was really awesome to be able to spend a lot of time with my father at that point and phase of my life. And then, as we went off to college, he ended up getting back into the business, not with the intention of building a large national business like we have today, but because he loves the business of being an insurance broker. The front row seat you get to so many different business success stories and the relationships that you're able to build with your clients. And it's true. This is the most amazing business in the world. Not only does it have all these incredible financial attributes like highly recurring revenue streams, high margins, high free cash flow conversion, all the reasons why private equity and investors broadly really enjoy this space. But in addition to that, the earnings power as an individual, the uncapped nature of that only being kind of your own kind of time and ingenuity, and how you can really kind of see the way in which what we do facilitates so many important moments and milestones in individuals' lives and businesses' trajectories. That ability to buy a home, to provide life insurance at the formation of a family, to ensure the build out of a factory, or various business interests. It's insurance is truly the lubricant of capitalist economies, and then as an individual insurance professional, the living you can make, the relationships you can build. It's an amazing business. So he was doing that. He started our predecessor business in 2006. He had done that with a few partners. I joined, and really with this view that I thought there was an opportunity to do something different, to build a platform for fellow insurance professionals and entrepreneurs. And I'll circle back to that in a moment. But I spent the first year there really helping to reorganize the business, consolidate the equity. We sold some non-core parts of the business off that he had accumulated over the first few years. And we launched what is today the Baldwin Group in January of 2011. In that year, we generated $5.5 million of revenue. We had about 35 colleagues, and we were a Tampa-centric insurance brokerage business, but one that had really large aspirations. And those aspirations were really centered around what we were observing in the marketplace. And this was about the time, Al, that you'll remember well, when USI and Hub had both been taken private by various private equity firms. And during one of the most disrupted periods from a financial returns perspective in recent history, both those deals returned 3 times their money over like 3 or 4 years. And the entire private equity industry lifted up their head and said, whoa, we need to learn more about this insurance brokerage business. We just thought that was some sleepy old industry, but maybe there's something more here. And that really kicked off more than a decade of accelerated consolidation across the industry. And our observation was that while it was very clear why and how shareholders of those businesses were better off as a result of that consolidation, in many cases, it was less clear to us why and how the colleagues and the clients were better off. Because scale, when built thoughtfully for the benefit of clients and colleagues, can be amazing. It can create accelerated career development and career tracks. It can enable a level and a degree of investment in depth and breadth of resources and expertise and capabilities that enables professionals to kind of serve clients more effectively and more broadly. And it can, in general, enable better, more thoughtful outcomes for all of those stakeholders. But conversely, scale not built thoughtfully, or scale just for the sake of scale, can create the opposite of that. It engenders bureaucracy. It creates waste. It stifles innovation and limits connectivity in a way that can disenfranchise the colleagues, that can lead to less optimal client outcomes. And so we said, we want to build the anti-aggregator. Is there a path for us to go build a platform and go across the U.S. to fellow insurance professionals and entrepreneurs and say, to those who see the value of scale when built thoughtfully, and want to sell into that, not sell out, but be a part of building kind of the next generation, that broker of the future, let's come together and share in our collective know-how, our wisdom, our expertise in a manner that will enable us collectively to achieve things that we would otherwise be unable to do on our own. And that at the very core of the strategic thesis and strategy that we had starting out. So from 2011 to 2015, we really just bootstrapped the business. We were out winning clients. A lot of what I did was production. I still have a book of business today. Even as the CEO, I think it's incredibly important that we don't distance ourselves from the way in which we create value and deliver our services to clients and to the market. And so to this day, the $3+ million book of business, and while I'm not as involved as maybe I once was 10 or 15 years ago, I enjoy very much the opportunity to go sit in front of clients, brainstorm around the most effective and efficient risk transfer strategies and structures, and do the work of a broker. And along that time, we were also building our foundation in our culture. As you mentioned it earlier, Al, this business is all about relationships. Said differently, it's all about people. It's a knowledge-based business. What we sell, what we trade in is the know-how and the expertise of our professionals. They go up and down the elevator every day. And the only long-term competitive advantage that I believe any business in our space can cultivate is the ability to attract and retain the very best and the very brightest professionals. And so for the first 6 months of our existence, we sat in a room once a week as a leadership team and began writing out what were our non-negotiables, who were our core stakeholders, what was the language that mattered to us. And we built a document that you've seen quite often called our azimuth. And the azimuth is what I refer to as our corporate constitution. It goes far deeper than kind of your traditional core values and mission and vision statement. Of course, we have all of that, but we talk about who our stakeholders are. And from the very beginning, before it was in vogue to have stakeholders beyond your shareholder, we developed the view that you take care of your colleagues, they take care of your clients. You have good, trusted, transparent, and forthright relationships with your insurance company partners, and you reinvest in the communities that you live, work, and have fun in. And if you make decisions through the lens of what is going to uphold the best interest of those stakeholders, then the success of your shareholders over time will follow. And that has been the way we operate this business through and through, and it's been abundantly true so far. We also define language because language matters, and it enables to create this kind of tribe-like way in which the organization binds itself together across offices and geographies. So while these may seem relatively small and nuanced differences, we have clients, not customers. We complete partnerships, not acquisitions. We have colleagues, not employees. We believe that those nuances go a very long ways in reinforcing the level of collegiality, professionalism, and esprit de corps that we're looking to exhibit and ultimately inculcate across our footprint. And so I think that was incredibly important. And at the same time, my father is really the one who kind of originally concocted our go-to-market strategy from a client and prospect perspective, which is our risk mapping process. We developed a 5-step diagnostic client engagement model that enables us to really deconstruct the insurance and risk architecture, employee benefits planning, and strategy and compliance of our clients. When we take prospective clients through that process, which has certainly evolved and improved over the years, we win them via broker record letter 87% of the time, industry leading win rate. And so that, among a lot of other things, you begin building the tools and the resources to really attract top tier professionals. So into 2015, as you mentioned, I think we finished that year about $33 million in revenue. We felt like, okay, it's time for us to take the next step. We're ready to begin scaling this business more meaningfully. And at that point, we went out and we raised outside capital into the business for the first time from a family office, also happened to be a client. They invested $125 million in our business, and to this day have not sold a share. They're our largest shareholder outside of my family. It's been an amazing relationship. And That's about the time that I cold called you, Al.
Mm-hmm.
I reached out to you. I think it may have been April or May of 2016. I said, Al, you don't know me, but I know of you because you do so much M&A activity in this industry. And I want to come meet you because I'm building an amazing brokerage firm and we're going to do business together. And I don't know what you were thinking. You were probably like, who's this guy, Trevor Baldwin? But
No,
I
no, I
flew up
do.
to New York,
Yeah.
and as you mentioned, we met at the Four Seasons. We had a great lunch. I outlined for you our vision and what I thought we were going to be able to build, and we started doing business together. And some of the first deals we did were with you, Al, and I can't thank you enough for the trust and confidence you had to bring your clients to us, and for us to have that opportunity to be able to begin doing business. So over the next 3 years, we began scaling the business not only organically, which had always been kind of that is the foundation of our business is we are an organic growth machine. I've fundamentally believe the number one measure of health of a brokerage firm is organic growth. If you're growing faster than your peers, then that means you're out winning and taking share. That means your clients are honoring you with renewals at an outsized rate because of the value and satisfaction that they have. Most importantly, it means your colleagues are showing up in a super powerful way every single day to enable those outcomes. But in addition to that, we wanted to accelerate things. And so we began our partnership strategy, our nomenclature for mergers and acquisitions. And over the next few years, through a combination of organic and acquired growth, we scaled the business up to about 135 million of revenue in 2019. And along the ways, we had a number of conversations, as you mentioned earlier, with various private equity firms, family offices, just continuing to explore the continuum of capital options available to us as we had an inkling that we were going to need to continue to fund the business to fully achieve our aspirations. Uh, Ultimately, in 2019, we got very close to taking an investment from a family office, but I ended up walking away from that deal because it became clear to me that if I took that capital, I was likely starting the clock on when our business was ultimately going to be for sale. And it's not that that's a problem. I never say never to anything. We always have to have an open mind about what's going to be best for our business, for our people, for our clients. But the promise I have been making and continue to make to our partners is we are going to build and invest in a way that enables us to create a forever business. Doesn't mean it will be around forever. I hope it will. But it means that we need to set up our capital structure. We need to invest in our infrastructure and our resources to support continued long-term growth and success and scaling. And so we ultimately decided that the best path for us, which had not been done in over 20 years at the time, was to take the company public. And over a 6-month time period, we raced towards that objective and ultimately successfully IPO'd the business in October of 2019. And at that point, we were, as I mentioned, 135 million of revenue, about 35 million of EBITDA. And we were the first commercial insurance brokerage platform to go public in over 20 years. We reopened the market.
Yep.
And from that point, now we had a currency with significantly more capital. And we had a story because of the prominence of the IPO and the nature of that process that began to be much more well understood. And so over the next 2.5 years, we completed 35 partnerships, or nomenclature for a merger and acquisition, acquiring about 536 million of revenue. And then at the same time, accelerated the rate at which we were growing the business organically, growing over 600 million of organic revenue growth to finish 2024 at about $1.4 billion of revenue. So 10xing the business over the first 5 years since our IPO, both in top and bottom line. And over the same time periods, we made meaningful strides in the strategic advancement of our goals to build really the most comprehensive insurance risk management and employee benefits advisory platform that exists, period. And our overall thesis, there's a few of them, but really resides around a view that one, you build a platform with an incredible culture that invests in the tools and the resources to execute for clients at the highest level. You will attract the best talent in the industry, hands down. And I think we do that. I firmly believe it. Two, from the very beginning, and you'll remember this, Al, because you used to give me a hard time. We we were non-negotiable about the fact that we were integrating the business. And as you'll recall, there was a period of time where decentralized was
Yeah,
very much in vogue.
very much.
And it's,
Yep.
hey, sell your business to us. We're an aggregator. We'll leave your name. We won't integrate you. You just wake up the next day and you keep doing what you're doing. And that's, that may be the right strategy for some people, but our view is we're building an operating business and we're not going to be able to build scale for the benefit of our clients and colleagues if we don't integrate and have a common way in which we align business processes, systems, org structure, accessibility of resources and professionals and capabilities. And so that's what we did. And it's a lot of work. And a number of our peers and competitors now have a tremendous amount of deferred maintenance around the integration work that they have to do to prepare for the next events that they have in their future. Additionally, we had a view around vertical integration and how that can enable innovation on behalf of our clients. And so we had acquired an MGA platform in 2019 to do just that. At the time of the IPO, they had about 18 people, 60 million of premium, and a single product. And today, with only, I think, 3 partnerships that have been completed into that segment, we have about $1.2 billion of premium under management across 22 products and nearly 800 professionals. It is an incredible business built on a completely proprietary tech stack that enables us to build proprietary insurance product that uniquely solves the issues and challenges that our clients face, and what that enables relative putting that proprietary product in the hands of our risk advisors or at embedded points of distribution is an enduring competitive advantage. And then we saw this opportunity to build a tech forward embedded personal line strategy. And so today we have a more than $300 million personal insurance business that's the leading purveyor of home insurance, appointing new home sale and mortgage origination. But we embed a point of transaction, and we are the solution for 20 of the top 25 home builders in the country. I firmly believe that is the future of how home and auto insurance will be distributed because it's tied to that transaction. In our IS business, which is really that kind of middle market, and now when you include CAC risk management platform, it's over $1 billion of revenue, is the leading platform for the most discerning clients and the very best insurance professionals. So today, pro forma for the combination with CAC, the beginning of this year, our business on a run rate's about $2 billion of revenue. Half of that is in retail brokerage, and where we have the ability to serve clients across the continuum of scale and complexity. We then have our UCTS segment, which includes MGAs, risk capital formation, reinsurance brokerage, ILS, captive management. It's about over 600 million of revenue. And then our Main Street business, personal insurance for everyday Americans, distributed at point of transaction in a tech-enabled and seamless fashion, which is over 300 million of revenue. So, we have come a long ways over, I guess the last 6.5, 7 years. But I also have this feeling that we're just getting started. When we took the company public, Al, I had announced a goal at the time, top 10 and 10, which is we were going to build a top 10 broker over the next 10 years. And here we are, I think, about 7 years in, not quite. And, when you include CAC, we're number 12. So I'm feeling really good about the path we're on there. And then our intermediate term goal of announced last year of 3B30, which is by 2029, we plan to achieve $3 billion of revenue at a 30% adjusted EBITDA margin as a marker of our continued growth and success. So that's I guess that's kind of the very high level part of the story, but happy to dive in and kind of take the conversation wherever you want to go.
Oh, wow. I mean, that was awesome, buddy. Fantastic overview. You covered a lot in a short period of time. A couple comments. It's interesting that the growth has been unbelievable, and it's not just through acquisition, because you're really growing at a level that probably is outperforming a fair amount of your peer group, right? And recently,
Yeah.
some of your peers who were of the same scale, it got to a point because they did not go public. And listen, when you went public, at 135 million at 35 of EBITDA, I think that was that was a big leap. I think it was probably borderline whether you were even big enough to do it. And I'm just saying that not disrespectfully, but obviously you pulled it
Yep.
off. So
That's accurate.
now the challenge is, okay, for folks in your peer group are, if you're not preparing to go public yourself, which it takes a while to do it in 6 months, is lightning fast anyway, in my opinion.
It is.
Okay. All right. To do it like you did it and then succeeding is amazing because, a lot of the peers you had were the private equity backed. You didn't go that route. They had tremendous success. Okay. And built nice companies. Yes, you're right. And I'm sorry if I gave you a hard time. I don't quite remember giving you a hard time. I might have said, hey, buddy, what are you worried about integrating all this stuff for? Because you're right. There was a time when this real influx of private equity capital came in, okay, that the decentralized model was the hot model, okay? But unfortunately,
That's right.
some people, didn't forecast it like you did. You were ahead of your time by integrating right away. And now if you're not integrated, you're in trouble, okay? And the folks that haven't integrated and are trying to integrate later in the game, it's been much more difficult. But the interesting thing, I think, Trevor, to what you're saying is like, I look at it now. The world has changed. Nobody could have forecasted some of the firms, which were excellent firms, that, they would be going out again. They were private equity backed. They had several sponsors over, 10, 15 year period. They got the multiple arbitrage on the 3 to 4 times the hit for the shareholders. So everyone was creating that wealth. But you got to a size, and I don't think anybody anticipated for some of those firms that when they got out there, that they would be looking at, saying, oh, geez, we probably can get another sponsor to sit alongside our current sponsor. That was what's trending, and some LPs alongside of it, and we'll make it all work. And then, for the next 5 years, and then we'll go public. Okay? Because if you're not prepared to go public, you're not going public. Right? It's no easy thing. You're the poster child for that, how hard it is to even get there. And then when you found out that the larger institutional investors were looking at this and saying, yeah, we can do this, but not at the values you're expecting. Okay. It was a total reset in my mind that took place. So, what has that done? Have the values on the kind of deals that you're purchasing gone down? Not really. I mean, those haven't gone down, but your competitors, those who are competing with you in the external growth, organic growth game at your size, now have to take a whole different look and a whole different avenue. And their options aren't as grand as they thought they were. Okay. And I don't think people were ready for what they saw because they weren't prepared. And I don't know whose fault that is, but I've always tried to be a student of the market, best I can, to try to, we've been involved in 12 different events, recapitalization type events, give or take, soon to be a couple more this year. And I always try to get out front of it because you want to see what people are doing and who's really hot to do what you need to get done. All right. And how viable it is. So, I mean, I'm curious to your take on some of those events that took place, recently with, the $1 billion, $2 billion firms like you that didn't go public, Didn't take the chance. And listen, I give you a hell of a lot of credit. I mean, I'm not saying it negatively at all. You withstood the test of time. I think a lot of people probably scratched their head when you decided at that size to give it a whirl, and you did. You're the first one to do it. But I think a lot of them are going to have to try to do it. I'm not sure they're all prepared to do it, or you're going to see the same result that there's going to be combinations of some of the ones that are 700-800 million combining to maybe try to go public together, or you're going to see some of them going and combining with strategics that like yourself that are already in play. What are your thoughts around the marketplace today?
So, Al, I think maybe there's a number of factors here, but to start, there's no perfect capital structure out there. Like, look, we're public, and I get asked all the time, if you had to do it over again, would you still do it? And I don't have to hesitate. The answer is yes, because we would not have had the success, have the scale we have today, or own as much of the company as my colleagues and I do today. We're more than half of our company is owned by insiders if we hadn't gone public, just because of the benefits of the currency we had and the valuation dynamics. But look, there's been some dark days. Like, look, as we sit here right now, my stock is touching new lows. And so it's not for the faint of heart. I kind of, if you've ever read a poem by Teddy Roosevelt, The Man in the Arena, I feel like that appropriately describes what it's like running, leading, and being a part of a public company, which is, some days it's great. And when everything's going your way, when the business is performing, when the markets are cooperating, there's no better place to be than the public markets. But when maybe your business has a blemish, which happens to most businesses from time to time, right? Or the market isn't necessarily cooperating for any myriad of reasons, there's really not a worse place to be, because you're doing it all on stage and everybody's watching and judging your every move. But that's the path we chose. And I genuinely believe we are a better business as a result of it. The level of rigor and discipline that is required to operate in the public markets is incomparable to what is required in the private markets. So, coming back, though, just to your question around what's happening, the market dynamics, I think you hear today like, oh, the private equity model is broken, or the returns don't work anymore. And I don't know that that accurately reflects what the underlying issues are. It's not that the private equity model is broken. Like, that's just a capital structure.
Right.
It's that certain business strategies aren't going to drive the same returns as maybe they once did. And there's a lot of factors for that. The first of which is the past decade was probably the best 10 years to own and operate an insurance brokerage business in the history of owning insurance brokerage businesses. I mean, everything was going right. You had constructive rate. You had interest rates for the majority of that time period that were near zero. You had a healthy arbitrage between tuck-in and platform multiples. And so these businesses grew organically, whether or not they knew how to write new business, just because the market and inflation and rate was carrying them forward. You could do M&A and create real arbitrage value, and debt was widely available at very attractive terms and conditions. And so I think a lot of people convinced themselves that they had really good businesses or were really good operators, when in reality, they were just incredibly fortunate to be in the right place at the right time. I don't want to discount that, because like that applies to me too. And we enjoyed the hell out of that decade. But now let's fast forward to where we are now. Well, because of the good work that folks like you have done on the intermediary side, the arbitrage between tuck-in multiples and platform multiples is much tighter. So your room for error there is much less. You've got to be very thoughtful and precise around the M&A you're doing, and you've got to achieve the synergies in order for that to create real value. The market is pretty bumpy right now. I mean, you've got the property market last year that took a pretty violent turn down from a pricing standpoint, with kind of large shared cat exposed programs coming down upwards of 40% in rate at times. Um, and while the casualty market still, you know, has some rate need and is continuing to get that rate, it's ebbing. Whereas 2 years ago, maybe an heavy auto schedule was going to renew at 10, 12, mid teens renewal rates. Today, maybe that's mid or even low single digits. And then, everybody, I think this is the least well understood is I think people attribute, both the growth that was occurring over the past few years and the lack of tailwinds that exist today largely to insurance rate. I actually don't think that's the case. I think that's maybe only a third of what's happening. I think the bigger dynamic is the inflation that has come out of exposure units. And so I think we were seeing inflation drive exposure unit expansion at mid to high single digits for multiple years in a row. And as you know, insurance is priced on those exposure units. As that goes up, the premiums go up. You take commissions, you ride on that. And now the rate of change that we're seeing is drastic between both insurance rate and the exposure unit expansion coming out. You're seeing like 10 plus point negative swings from the type of renewal premium change you were getting 12 months ago to what you're seeing today. And that is a massive headwind to organic growth for people. And so, as we talked about, integration matters today. And folks talk about the need for integration because you can't go public without it. But I think that also skips over the underlying factor of why it's needed. You don't necessarily need to be fully integrated to go public. You've got to have controls, but there's different ways that you can go about accomplishing that. The reason you need to be integrated in today's market is because you got to be able to operate the business. You got to be able to turn the ship. You got to be able to turn the dials in a manner that's going to enable you to drive differentiated new business outcomes. What's your sales velocity? What's client retention doing? You got to know what those are. And then you got to be able to have the tools and the organizational structure that's intact to enable you to enact change. And I think that's what's going on right now is it's not that private equity as a capital structure is broken. It's that the way in which many of the private equity backed businesses were driving returns, that is no longer available in the market today because the ARB from an M&A standpoint doesn't exist the way it did. And as the businesses scale, it's a law of large numbers. You just can't do enough M&A necessarily to move the needle unless you're doing big transformative deals. The market tailwinds don't exist, so organic growth has come out. And in fact, we've modeled this quite extensively. The breakpoint's around 250 million of EBITDA. If you're below 250 million of EBITDA as a platform, you can still probably move the needle a little bit, enough to drive some return and maybe an adequate private capital return with M&A. Once you're north of 250 million, it's organic growth. That's the only way you can drive enduring returns. And I think that's what oftentimes got missed with many of these businesses is they were scaling so rapidly. Were they building the infrastructure that was going to enable durable, sustainable new business, client retention, ultimately propelling outsized organic growth and margin accretion over time? And so I would suggest even a scaled brokerage business that has those attributes, they could exist in the private capital markets for quite some time. But if you don't, there's going to be a dearth of appetite from that market because the other dynamic is investors are underwriting to an IPO. And the reason is there's probably only a dozen private equity firms in the world that have enough capital to write the size check you need to write to buy a $1 billion+ agency. I mean, we're talking $2, $3, $4 billion equity checks now. Most of these, if you've got a $15 billion fund, they're generally only going to reserve, maybe 8 or 10% of that fund for any single investment. So you're looking at $1.5 billion check sizes, and you got to bring LPs and sovereign wealth funds alongside. And that gets like, you're orchestrating a lot of constituents at that point. And when people are deploying that quantum of capital, they want a cushion. They want to know they're going to be able to hit the mark and drive the returns that they're shooting for. So I think that's really the dynamic that we have going on here. And so we have a market in transition where the last decade was the Goldilocks era for insurance brokerage. And now the next decade is going to be a more normalized environment. And as Warren Buffett says, when the tide goes out, we're going to see who was wearing clothes. And we're going to understand now who's built a business that knows how to grow organically, that knows how to go win share, write new business, retain those clients, attract talent, continue to create those career trajectory opportunities for the professionals. And I feel really good about how we're positioned coming into that environment because it's such a unique opportunity for us to showcase all the hard work we've been doing over the past 5 to 6 years building the platform that we have. Because our sales velocity is top decile. It's high teens, low 20s year in, year out since we've gone public. Our client retention continues to be incredibly strong. And I can tell you how the quality of the talent inside our business is remarkable. When we add in the CAC colleagues that recently joined us, doesn't matter if you're a global, Fortune 100 company or a small, private capital backed tech or life sciences startup, we have the ability to serve these clients across the continuum of scale and complexity, protecting the possible and ensuring that our clients have the peace of mind to continue pursuing their passion, their dreams, and their business pursuits. So I'm excited, but it's going to be definitely a more complex environment to navigate over the coming years.
No, there's no doubt, and very well said. And you touched on several things that I've been saying, maybe a little bit different than you're saying it, but it's not just you don't need to be fully integrated, but you need to be integrated not just to go public. You need to be integrated to get a new sponsor or get any kind of investor these days. It's the decentralized model has left the building. Okay, it's left the industry. It doesn't work anymore. We've said it in multiple podcasts. And as you know, I've had several private equities guys, that I've had success with on this, and nobody's saying that they don't love insurance brokerage. Still, it's still the darling. Like you pointed out, all the things I point out, and the one thing you didn't point out is most of the lines of business you need the product by law, right? So you have to have it.
It's mandatory. It's a compulsory product.
That to the high margin. It's I call it, Trevor, the best. It used to be the best kept secret of an industry that isn't a secret anymore, and it's so lucrative, and not a lot of young people want to come into it because it's not sexy. Insurance. Oh, I have to buy insurance. You don't have a claim. All you do is pay premiums. When you have a claim, that's the value, and that's when the insurance broker really shows their value. When the claims need to be paid, because really that's the end outcome. But that being said, you touched on a couple of things, and it's funny you used the $250 million mark. I was saying about 300 million. What we've seen is that now, people are being looked at. You're at the 300 million of EBITDA level, that level and above. You are being looked at and judged like a public when you're coming out. So the limitations for who can actually be a sponsor on something like that. You said about a dozen people, you're probably right. It's in that ballpark, 10 or so. What we've tried to do is position ourselves with those because there are a couple of the firms that we're involved in and we invested in when we brought the capital in that are going to be doing something this year. And we want to know who's who. But yeah, the options are not nearly as grandioso, okay, as they were. And it's very
the oxygen gets thin, as they say.
Exactly.
When you get up into that size category.
Exactly. And even some of the smaller ones below that, we're going to see and we're going to test here. We're involved in something that's smaller than that we're going to be involved. We're going to see what the market bears for that, because they can get a direct sponsor still, someone like that. Okay. They're still worthy for that, but we'll see how things affected and so on and so forth. But, I think the interest rates going up had a lot to do with it. Okay. I think it changed the ball game. Like you said, it was you said, it was, I forget how you termed it, but I called it the Wild West the last 10 or 12 years. All right. It was just, if you had 10 people look at a deal, you got 10 bids. It was easy. The interest rates were zero. right? Now, what we've seen over the last several years, the interest rates go up. The values are still good because it's still very competitive because people that want to win deals, they're being a lot more selective with their cash because it's harder to get it. It's much more expensive, you know? And the one thing that's been consistent is, people that have stayed, consistent with having private equity and maintaining that one level of stock, that works real well because once you start dipping into the pref pool, we all know where that goes, and that's a tough pool to get out of. Okay, unfortunately, and there's some people that really really relied on that, the debt versus the equity, and it's unfortunate, but yeah, I mean, I'm seeing the change. We're still very much active, as still doing a bunch of transactions, but we're being really smart on the things that we get involved in and the people we get involved in because, it's not just about, how much money you can get them. The values are never a problem. You can always get people good values. It's really finding the right situation and the right people and the right partner. Because if you go into these things with the right mindset, it's not just what you get at the front end. It's what you get overall. Okay, between the right equity partner, the holding the right equity for the right reasons, and the growth. All right, it's always been growth and profitability for me. That's how we built this business. Mike Fletcher and I, my partner Ray Somerville, we're very focused on making our clients understand, what they're really setting out to do. There's always the folks that just, get me the most money out. They don't care. And, even the ones that don't want that, we still get them a really good financial, a transaction. But, you said a couple of things that really resonated with what I've been saying. And I think it was very well said. I think there's a lot of still going to be an opportunity, but I think you're going to see more combinations at the higher end. Okay, more people coming together in order to succeed, to hit their goals. And it'll be interesting to see how many more private equity backed brokers evolve because, just to get private equity money, that's great. But, it depends on what you want to be. All right. Because, just because you have the private equity money, there's no guarantee you're going to grow to the levels, okay, that some people, have done. And including yourself, who, really, you did it with your own money, the family office group, I remember it like it was yesterday. And you were one of the few people that actually succeeded with family office money. To be honest with you, if you look at your peers, majority of them haven't done it with family office. They either did it by getting PE money or they got to go public. And like you said, the hubs and the USIs went back private. And at some point, they're probably going to have to go back public, right? Because, at their size and scale, there's not a lot of alternatives. But no, super well said. I kind of chuckled to myself a little bit when you said you still have your $3 million book of business. Well, a very good friend of mine, and he did a podcast with me and built one of the best privately held companies, I thought, for years. Mike Christian of Risk Strategies had the same philosophy you did. He maintained that book of business for forever because he wanted to stay in touch with the client. And, the thing that's, I think, important for you, Trevor, and if I had to give you a piece of advice as a guy that's got a little more gray hair than you, is don't get out of that. Okay. Don't get out of the M&A. Keep yourself in front of the people that you're bringing in, and don't get out of the clients, because that's a testament to your people that they see that you're not just sitting on the top of the ivory tower, that you're actually getting your hands dirty still. And that's what I think people really respect in a leader.
Absolutely. Yeah, and I appreciate the advice, and I agree wholeheartedly there, Al. And you mentioned a couple of things that I think are important to reinforce, which is not all equity is equal. And I think there's some recent examples of private capital backed businesses that exhibit that, where, employee shareholders that had various classes of stock ultimately realized that equity was not worth what maybe they thought it was. And I think there's some real examples of that still looming out there, whether it's, private capital backed businesses with, abnormally highly adjusted EBITDA, and employee equity that's largely kind of laddered out options at various strike prices. I mean, that's a super dangerous, highly combustible capital structure. And I think, unfortunately for many, I think they'll ultimately wake up and find out that they had far less value than they thought. And so I can't reinforce enough the importance of a very simple capital stack, a single or kind of, common shareholding class. Because if not, there's a lot of ways in which when you're private, you can articulate how well a business is doing, but it can be very different financial outcomes for holders of different securities of the same business. And that is super, super dangerous.
No, it's critical. We always speak to our clients about the power of that one class of stock because everyone's aligned. It's all about alignment, right? The equity aligns everybody to cross sell, to grow together, to create value together. It's very, very important. So, Trev, the last thing I leave you with, I mean, you're building a best in class business, a very sophisticated set of clientele. You're not, you're a different. You mentioned a lot of the different divisions and things you have, but where you sit today, who's your competition? Who do you feel? I mean, are you playing, obviously with just the larger firms, where you see you're competing for not just acquisitions but clientele and whatnot? Are you going up against the other publics? Some of the big publics that the Marshes, the Aons, the Willises that kind of sit in a bubble by themselves, don't really acquire businesses like you do, but have a certain class of clientele that kind of meshes to them and a certain kind of employee. I mean, you've certainly attracted a lot of good talent from firms like that. I know you got some really good talent, and some of the people in your leadership team. But do you have any specific people that are more competitive against you than not?
Yeah, I think that's the beauty of where our industry still is, Al, which is despite the fact that we've been through more than a decade of pretty intense consolidation, it's still a highly fragmented business. And so if I looked at the last 100 clients we won, they probably have come from 70 different brokers. And yes, we oftentimes compete with the Marshes and the Aons and the Willises of the world, but we also compete with, the regionals and the local agent that's got a shingle out on the street corner and everybody in between. And so I'd say in general, for that upper mid market and national account space, it tends to be, the regionals and the large national and global brokers. But it's a highly fragmented space still. And candidly, I think we're going to begin seeing some regeneration as many of these larger private capital backed businesses are acquired or merge, and the necessary action is taken to take cost out to drive the needed returns. It's going to create a lot of disruption, and I think we're going to see a fair amount of new agency formation as a result.
I mean, it's going to be interesting to see, and that's a great answer. And I always viewed you as that middle market to upper middle market firm. I was just curious as you grew, is it targeted in one way or the other? But you're right. You got to be an opportunist. It's not like you're writing pizzerias and drugstores. Okay, but you're focused on the good middle market, upper middle market client, and really, at your size and scale, the competitors vary. And it's really kind of the class
That's
of
right.
business more than anything that you're going after, right? That's how you differentiate yourself, and I think
That's
you've done a
exactly
great
right.
job with that. You've done a great job with that as far as how you've divided the divisions, not just anymore just retail, but wholesale and MGA and whatnot. In fact, like I said, we just looked at a really good MGA together recently, and so on and so forth. So, look, I think you're positioned really well. Like you said, you can't control everything that goes on all the time. You're constantly under scrutiny as a public. That's just the name of the game. But like you said, you wouldn't trade it for anything. And it's a great challenge every day, I'm sure, to be the best you can be. And I think you've done an awesome job. You yourself, a great leader. highly respected. I know I got a ton of respect for you, as do my firm and my people, my partners. And we're very fortunate to be working with you. And, for me, unless you have anything else, I thought you did a fantastic job here today. Very informative. And I really thank you for taking the time.
Thank you, Al. It's been a real pleasure to be here with you. And, likewise, we really enjoy the relationship with you, your partners in your firm, and look forward to continuing that well into the future.
Which we will, and we'll keep rolling here, buddy. Thanks again.
For more information about your unique situation, please contact Sika Fletcher or visit us at www.sikafletcher.com. All opinions expressed by the host and guests are their own and are not necessarily those of Sika Fletcher. This podcast is for informational purposes only and should not be relied upon as professional advice. Sika Fletcher employees and clients may have positions in the firms discussed in this podcast. Any information provided is subject to change and does not constitute an offer to purchase or sell any financial product. Sika Fletcher LLC does not underwrite securities, nor advise on, nor affect transactions in securities for the account of others.